So, John, we've talked a long time about pound volatility being suppressed, and guess what? Here it comes. I've got a chart here. It's in the library, just showing 1 month and 3 month implied volatility on cable rising. So the 3 month implied vol obviously takes us to the end of the year. If we get this summit in November and we get a deal, does this pound volatility come down?
Well, maybe if the summit's successful, I suppose. This is interesting because it wasn't that long ago that October was being repeatedly talked about as the deadline for this deal to be done, particularly by the EU side. And now we're suddenly seeing relief that a summit may be happening in November, a month later. I mean, one of the reasons volatility is picking up, frankly, is because time is getting short. And this does also mask, although there's some relief, of course, that does mask more serious underlying problems. It seems the only way we're going to get to this deal is by a lot of issues being pushed out into the future, into the transition period, because they're not reconcilable at this point in time. So yes, relief on one hand, and yes, therefore volatility in due course might die back down again, but asking more questions than it answers in many ways, I think.
You know, John, one of the things is about the politics is at play, but also the data has been, I suppose, a little bit of a relief, a little bit of surprise, I think, for the market. So I think the pound is being driven, A, by Brexit, Barnier comments, B, by the data. The pound is catching up with the data. But the market is still not pricing in aggressive price hikes. We put this in months to the first price hike, still 12 months away nearly. The market doesn't think you're going to get a hike until nearly the end of next year. I think that's very dovish. So the risk is for the minutes maybe we get a hawkish tilt?
Well, yeah, I mean, I think more of a signal that the MPC is even more confident than it was in August that raising rates was the appropriate thing to do. As you say, not all the data, but certainly some of it is, is printing as well or better than most people expected. So there is a degree of that in what we've seen, for example, in sterling as well. I think the point about interest rate expectations is an interesting one because whether it's November next year or some other point, the key here is it's after the end of the current phase of the Brexit negotiations. It's after the UK leaves the EU and either does or doesn't go into transition. Yeah. There's a binary prospect in course here. Yes, if things go well, ultimately, rates may well go up sooner than priced in, but if they go badly, they could go the other way.
And Mark Carney, to deal with Brexit, staying on now till January 2020, how many hikes might we get before the end of his new term?
I mean, as I say, if things go well, then there's certainly a case for one, if not two hikes next year. And then at that point, the governor, it seems, will ultimately be leaving. There's an irony in this as well. By staying on, it does deal with those initial months after March 2019. But this is all going to come back around later in 2020 as we head to the end of the transition period. And having swept a lot under the carpet, those issues are going to be even more serious and intractable as we get through towards the second half of the transition period. So if he leaves then, there's still going to be some serious volatility, I think, around.